Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Minutes from the Federal Reserve's meeting released yesterday revealed that some officials preferred a more gradual pace of rate cuts, reflecting the economy's resilience despite what the Fed calls restrictive policy. Fed Chair Powell described the recent half-point rate cut as a recalibration to keep the labor market strong. Asian equities rose today morning following fresh highs in the US market ahead of inflation data that could potentially shape the Fed's policy easing in the coming months. Meanwhile, the Reserve Bank of India eased its hawkish stance, and FTSE Russell, which we discussed yesterday, added India to its emerging market debt index on Wednesday. However, a sad day for the world as the legendary Ratan Tata sadly passed away, a man who truly stood for the principle of doing good business for the society. Good morning, JK. Your thoughts on the recent developments and your take on the upcoming US CPI.
Good morning, Swaraj. Yes, start with bowing my head to the really great leader of business, and this contribution to Indian economy cannot be overstated at all. Yesterday was another day of central bank watch, and up close it was our own RBI rate decision. MPC keeping rates unchanged, but shifted the stance from withdrawal of accommodation to neutral, with the governor saying change in policy stance gives central bank more flexibility and optionality. This move, along with the lower inflation projection for last quarter of the financial year, has given rise to market expecting the first rate cut by RBI in January next. And that is a big takeaway from the budget, now from the governor's speech. His expression of confidence in sustaining the current account at the current level of 1.1% was a reassurance to the market that the exchange markets will also be stable. He even referred to the large reserves of over 700 billion, which gives me a sense that RBI will be using up those reserves to defend any excessive volatility in the rupee. And currently, we have seen that the rupee has been held well below 84 for quite some time, despite the large outflows that we have seen during the last 10 days. Did not have much impact on the rupee or the yields much from this MPC decision, because we have already seen some moves in the rates, and exchange rate has been controlled by RBI, and there is no real impact that we can see going forward as well. However, global factors are at play right now. Today we have the US CPI number, and then the Middle East conflict is ongoing. So we are more on the global factors to influence these financial markets in India rather than the RBI rate decision, which I think was a very balanced one. On the other side, in US, we had the Dallas Fed President Logan, somewhat on the hawkish side in her Fed speak, saying that last month's 0.5% rate cut in Fed funds rate was a more gradual path. Back to normal policy stance will be likely appropriate from here, meaning she actually prefers not a 0.5% cut from here on, but and 0.25% is what she would prefer, and also best balance is to risk, best balance the risk to our dual mandate goals. Again, the recent data on employment and other indicators have, been changing the tone of some of the Fed members as well. And minutes, of course, were more balanced as they were priced for, and key experts were like, almost all the participants saw upside risks to the inflation outlook as having diminished, while downside risks to employment were seen as having increased. But again, this is a statement that was issued 4 weeks back, and now we are actually in a situation where we have seen much stronger US labor data, for the month of September, along with the wage increases. The minutes, while it is hinting at the fact that the market should not expect the rates to be calibrated at higher than what the participants, or rather the Fed members, have indicated, is somewhat of a balanced statement. Which is what the market is also now trying to discount. While yields rose well above 4% for 2 and 10-year yesterday, the traders are now pricing in just 80% chance of 25 basis cut reduction, and significant factor is the 20% probability of Fed keeping on hold is also seen in the market's discounting. Market is definitely optimistic for today's inflation read. Core CPI expected to be 0.2% from 0.3% month-on-month basis. Annual figure remains unchanged, but it is a headline CPI year on year, which is expected to drop substantially to 2.3% from 2.5%, and that is the lowest level from April 2021. Number in line with these will not be a major market mover, because Fed has already stated that inflation is moving sustainably towards their target, but still it does give at least some comfort to the markets, who are still expecting up to 1% cut next year and up nearly 0.5% cut more this year. But if the number does come higher than what the market is already discounting, it can see more reaction from the risk of such and a dollar. Of course, apart from CPI, we'll also have the weekly jobless claims number expected to be higher at 230,000, previous one being 225,000. While major equities rallied, posting gains for all the major indices in the US, reacting to the Fed minutes, there has been an interesting development on the tech sector. The US government is weighing the breakup of one of world's largest and most consequential monopolies, Google, and they are saying that dismantling of Google's core business, separating it from Android, Chrome, and Google Play App Store. Basically, they are saying that the company was violating antitrust laws. Although this will take quite some time to come through, but it is a very big development on the tech sector. Breaking up one of the largest tech giants is something that is notable. And we are also hearing that China will have another. China government is also going to come up with the details of their fiscal package, which is more eagerly looked out for. But this will be coming only on Saturday. On the overall, dollar tested the highs of last 2 months yesterday on the basis of higher yields. Euro fell to once again supported to 1.0930, despite some very good number from Germany recently. The industrial production coming at plus 2.9% versus 2.9% minus that was expected, and the trade surplus posting a very healthy surplus. It's important to note that the support at 1.09 is holding on, but I think all depends on today's CPI number from US. Thank you.
Thank you, JK. And just quickly summarizing, the MPC decision, which we had yesterday, saw a shift of its stance from withdrawal of accommodation to a neutral stance. Markets are now expecting first rate cut by the RBI in January. Fed members recently have been more on the hawkish side, preferring a smaller cut. And that's also being indicated in the Fed minutes release yesterday, which was quite balanced. Traders are now pricing a 80% probability for a 25 basis point cut, while 20% is reserved for a no cut scenario. And the headline CPI today is expected to drop substantially to 2.1% from 2.3%, which was the previous print. But any upside surprise may trigger some more dollar strength. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.